it is something that is implemented by the central bank of the country. So the Reserve Bank of India implements it in India, the Fed implements it in US, and every country has its own central bank which is implementing this monetary policy. So it is implemented by the central bank of the country, and the main task as a part of the monetary policy is to either increase or decrease the money supply into the economy. So whenever it's an increase of the money supply, it gets called as expansionary monetary policy, and whenever it is decreasing the money supply, we call it as contractionary. Of course, when we move along, we'll see what each of them typically mean. So in short, monetary policy is something that is implemented by the central bank, and the main task of it is increase or decrease the money supply. And at the same time, whenever money supply is coming more into the system, means when banks are having more and more money, then the intention is they can lend them heavily. So an increasing in the money supply is also resulting in increasing of the credit in the country, and a decrease in the money supply will tighten the credit in the country. So from a monetary policies perspective, we see that the central bank can go ahead either coming out with an expansionary policy or with a contractionary policy. The main intention, again, depending on the current state of the economy, the policy should target towards the economic growth as well as the stable prices within the country. So stable prices is they have to control the inflation. So inflation at the same time bringing the economic growth. That is what would be the key objective of the policy. Similarly, the other important policy, fiscal policy, is implemented by the government of the country, not by the central bank. What does the government do? Here it plays around with spending. Spending is some kind of social spending it does. Probably it does the spending on infrastructure, roads, railways, the government's defense, government spends on various activities. So the different spendings of the government and taxation. Taxation is like a revenue to the government, right? How well the government is able to structure its spending and taxation to influence the economic growth. That is what we call it as a fiscal policy. What is the government's stance? What is the government's policy towards spending and tax collection? That goes as a part of the fiscal policy. So if the spending is more than the collection, obviously a deficit is going to be created. If the collection in the form of taxes is more than the spending, then the surplus is getting created in the process. So if the tax revenue is greater than the expenditure or the spending, a surplus comes up. If it is lesser than the expenditure, then a deficit is going to come up. And the objective of the fiscal policy also lies in terms of redistributing the income. Means charge tax from collect from the rich people in the form of taxes and pass on the benefits to the poor in terms of welfare schemes. Spend with the poor in terms of welfare schemes by charging the rich in the form of taxes, which means there is a redistribution of the wealth and the income that is coming out as a part of the fiscal policy. So on a broader scale, these are the conceptual aspects of these two policies. Now, before we go even more detail into each of them, because we'll try to deal with monetary policy to start with and then slowly move on to the fiscal policy. So, whenever the intention is talking about the money supply, monetary policy is more associated with the money supply. So, I really need to understand what is this money. what we could clearly see is money is today a widely accepted medium of exchange. We all know that. So earlier there used to be barter. I give this particular item to you, you give me some other item. Right? I'll give you rice, you give me wheat. That's a barter system. But today, when we are talking about in terms of money, then okay, I'll sell you rice, you give me this much of money, these many dollars. I'll sell you wheat, you give me these many dollars. So the medium of exchange and a means of a payment, money is one of the money has created a kind of a revolution in the current days world, and it's a unit of account because almost every item, the price of it is expressed in form of money, not in form of anything else. It is expressed in the form of dollars, Indian rupees, currencies of different countries, but yes, at the end it is expressed in the form of money itself. So there is a common base that is set for all goods and services. And it's a store of value also because I can save it today to make a purchase at a future point. And from traditional definitions perspective, we keep hearing money is classified as narrow money and broad. Narrow is purely the notes and coins which are in circulation and some kind of checkable bank deposits. But any other slightly less liquid assets that are being possessed, especially some kind of time deposits, money market mutual funds, all these things go more and more broader as a part of the broad money definition. And in some countries, even this narrow and broad is typically classified even more further. Like when we say M1, it's a very preliminary, highly liquid money, which is currency that is available with public, travelers checks which can be converted into cash immediately, demand deposits again convertible to cash, and deposits against which checks can be written, checkable kind of bank deposits, which means the money can be withdrawn at any point in time. So these are highly liquid kind of this is a highly liquid money, so that's where it gets classified as narrow. And in the broader, things keep slightly, okay, there is a savings account, there are time deposits, money market mutual funds, debts with longer maturity, because here it may be a maturity of 3 months or lesser, whereas here we can talk about 2 years. So as the maturity period keeps going and going up, as the difficulty in terms of converting it into cash keeps going and going up, we see that the money categorization also differs. But on a broader scale, we can very well visualize the money as either a narrow one or a broad one. And typically, when I have to talk about the money creation process, where in the very earlier days, in the very age-old days, there used to be promissory notes. And that's the reason you see on good amount of currency notes, for some countries, you still see, I promise to pay the bearer. So that is, it is acting as good as a promissory note itself. A promissory note used to exist for storing gold and precious metals, and with just a promise which says that we will return your gold after a certain point in time. And there used to be some interest which the banks used to charge in for typically holding the gold and securing the gold. But in this process, okay, let's assume something like this. A, B, C, different people have stored gold with the bank. So bank is acting as a store of gold and precious metals. Now, not all of them may withdraw it at the same time. They have stored it. They'll use it sometime later. They will not withdraw it at the same time, which means the bank is having this excess, this amount of gold, which it thought it can start lending out, at least some portion of gold, it can start lending out and create an interest out of it. That is what gave rise to the fractional reserve banking system, which is heavily observed in the today's world. A portion of whatever the gold or whatever the value of the metals that is there, it is lent to the other parties and interest came on that. So some portion of it has kept in the reserve because people can withdraw at any point in time. So to whatever extent they have visualized that people can withdraw, that has been kept in the reserve. Rest has been got into the lending process for some kind of an interest. So the borrower, now people have taken the loans. So these borrowers use this loan to make some kind of purchase, right, for consumption or for any kind of purchases. Now, so which means the seller of something received this loan amount. Now the seller can again bring the money into the bank. So it is a redepositing. And again for whatever amount that got redeposited, the bank can again do the relending process. Which means there is a cyclic effect that is going on. And whatever the initial amount of gold that was there, initial amount of money that was there, using that much of money, the bank is able to create deposits which are in multiples of the original cash. Let me just give an example. Let's say $1,000 came into the banking system now, and let's say the reserve, the bank thought it will keep 10% of it as the reserve, means it has given loan for 900, and this 900 again came back into the bank because the person who has borrowed, he has purchased something, the seller has redeposited it in the bank, and for this again 10% it has set aside and it has given a loan of 810. Again this 810 came into the bank, and after 10%, 81 being set aside, it is becoming 729. So what I could typically see is the deposits wise, yes, there is a deposit of 1000, there is a deposit of 900, there is a deposit of 810 and so on. Now like this the cycle keeps continuing, which means the overall deposit that is existing with the bank, just with the $1,000 note, $1,000 that came in, the overall deposit with the bank, if I add up as a geometric progression, I can very well look at it as A upon 1 minus R 9 by 10.9. So this is creating $10,000. So the deposits are to the extent of 10,000 just by using 1,000 in the form of money. So this has given rise to a growth in the banking system, the fractional reserve banking mechanism. Deposits are typically in multiples of the original cash. So the overall money that got created in the process is 1000 rupees divided by the reserve requirement, we said 10%. So that's the reason we got it as 10,000. And the money multiplier is nothing but 1 divided by the reserve requirement, coming up to 10, or I could have created it as the overall money created divided by the original amount. So 10 times the original cash is the total deposits that got created in the banking system. So if the reserve requirement is going lesser and lesser, the overall money created is going higher, and hence the money multiplier is also higher. And this is where the quantity theory of money comes out, which says whatever is the quantity